everyone, this is the course on principles of behavioral economics, lecture 31. So, with this lecture we are going to actually begin the fourth topic of mental accounting. So, this is the first module on mental accounting and we are just going to introduce the concept of mental accounting, that what mental accounting is primarily. All organizations from General Motors down to single person households have explicit and or implicit accounting systems. The accounting systems often influence decisions in unexpected ways. We will present a few anecdotes, each illustrating a type of behavior where a mental accounting system induces an individual to violate a simple economic principle. Now, these anecdotes are taken from the references mentioned here below, but you can always relate that similar kind of instances or situations also happen with each one of us or most of us many a times. So, the first anecdote says that Mr. and Mrs. L and Mr. and Mrs. H went on a fishing trip in the northwest and caught some salmon. They packed the fish and sent it home on an airline, but the fish were lost in transit. They received $300 from the airline. The couples take the money, go out to dinner and spend $225. They had never spent that much at a restaurant before. So, what is what is there to discuss here specifically? Anecdote 1 violates the principle of fungibility. So, we will first define what fungibility is. The characteristic of fungibility relates to the substitutability of different budget categories. If budgets are fungible, overspending in one category can be compensated by underspending in another category and vice versa, which alternatively says that you can spend the amount of money that you have on anything. That makes perfect sense, but if we go back a little earlier, a few decades ago or maybe a few years ago, or it is possible that it is true even with some households these days, that you would find that some amount of money is earmarked for some kind of expenditures. When there were no such use of PTMs or UPI payments and ATM payments, card payments, mostly there used to be cash transactions. So, maybe some 10-15 years ago even, then people used to withdraw cash from the bank and then they would be keeping them in separate envelopes earmarked for different spending. So, on grocery, suppose one household decides to spend not more than 5,000 in a month. On vegetables, there is an amount to be spent like say 2,000, 3,000, whatever. So, you generally try to confine your expenditure within that limit and you do not overspend or underspend, or in case you are able to save some amount of money from any particular account, then that is treated as saving. It is not that I could save some money from the grocery account, so I am going to spend it on the fruits and vegetables account or on clothing or something. So, of course, as you understand that when the budget is more stringent, then there is more violations of fungibility. People actually need to be more particular about their spendings, that on which head they are spending how much. Now, fungibility, actually a violation of fungibility here refers to the fact that when we do not consider any labels associated, or we consider that labels are associated with money. So, the amount that is earmarked for grocery should be spent on grocery, not more than that. But when there is no such thing, specifically when we have too much of online transactions where we are not able to track our transactions immediately and directly unless and until we write them down somewhere, then actually you have no idea about how much you are spending on grocery, how much you are spending on vegetables, clothing, furniture or house improvements on a monthly basis, on an annual basis and things like that. So, money probably might have become more fungible, but if you have budget categories, then money is not fungible. According to the neoclassical model, if the marginal utility of a good or service is greater than its marginal cost, then it should be worth buying and therefore complete fungibility should exist with no need for budgeting. That is what the neoclassicals say. Alternatively, neoclassical model says that money is not supposed to have labels attached to it. So, money is completely fungible. Yet the couples behaved the way they did because the $300 was put into both windfall gain and food accounts. The extravagant dinner would not have occurred had each couple received a yearly salary increase of $150, even though that would have been worth more in present value terms. Next, talk about a second anecdote. Mr. and Mrs. J have saved $15,000 toward the dream vacation home. They hope to buy the home in 5 years. The money earns 10% in a money market account. They just bought a new car for $11,000, which they financed with a 3-year car loan at 15%. So, what we see is that they have saved up an amount of 15,000. They wanted to buy a car of 11,000, but then instead of using this money, they have borrowed from the market, which is at a higher interest rate of 15%. Their money is earning 10%, but they are borrowing from the market at an interest rate of 15%. Now, when you have already some amount with you, you are not spending that in order to purchase the car. Instead, you are taking loan from the market, because that amount is actually earmarked for a particular purpose, right. So, here the violation of fungibility is caused by the household's appreciation for their own self-control problems. They are afraid that if the vacation home account is drawn down, it will not be repaid, while the bank will see that the car loan is paid off on schedule. So, the point is that beside the concept of fungibility, here we bring in another aspect of mental accounting, and that is how to exercise control on one's self. Anecdote 3. Mr. S admires a $125 cashmere sweater at the department store. He declines to buy it, feeling that it is too extravagant. It is very expensive. Later that month, he receives the same sweater from his wife for a birthday present. He is very happy. Mr. and Mrs. S have only joint bank accounts. So, what it implies is that specifically the money that he refused to spend was actually spent by his wife, and it is drawn from the same account. So, financial implications are same in both cases, whether he would buy it or his wife buys it. But still he could not buy it for himself, while when his wife gave it to him as a present, he was very happy. So, what's going on? This illustrates the curious fact that people tend to give as gifts items that the recipients would not buy for themselves, and that the recipients by and large approve of the strategy. So, the recipients are not buying it for themselves, but when others are buying for him or her, then they are actually approving of the strategy. Neoclassicals do not say so. They say that we must gift something which people are already purchasing, people have already used. That kind of thing should be given as gifts. So, mental accounting is trying to understand basically how our mind processes different transactions, purchases, etc. So, from that perspective, mental accounting is defined as the set of cognitive operations used by individuals and households to code, categorize and evaluate financial activities. Thus, mental accounting encompasses a broad range of human behavior and is not just restricted to financial activities. Like prospect theory, mental accounting theory or MAT was developed to overcome descriptive anomalies in the standard model, and it incorporates the basic elements of prospect theory in its formulation. So, the descriptive anomalies in the standard model, in the sense that standard model is of course normative, but then it failed to describe certain behaviors. So, those descriptive anomalies are, again, this is another attempt by mental accounting to address them. Perhaps the easiest way to define mental accounting is to compare it with financial and managerial accounting as practiced by organizations. Accounting is the system of recording and summarizing business and financial transactions in books and analyzing, verifying and reporting the results. So, this is how we can formally define accounting. Of course, individuals and households also need to record, summarize, analyze and report the results of transactions and other financial events. So, the way accounting is done by organizations, individuals and households may also need to do the same thing. They do so for reasons similar to those which motivate organizations to use managerial accounting, and the purpose is to keep trace of where their money is going and to keep spending under control. Of course, that it also adds to the fact that from where the money is coming, and then how we are spending it, how we can control our expenditures. Mental accounting is a description of the ways they do these things. So, the next question is how people perform mental accounting operations. Three components of mental accounting receive the most attention here. The first captures how outcomes are perceived and experienced, and how decisions are made and subsequently evaluated. For example, Taylor presents an anecdote such as, a friend of mine was once shopping for a quilted bedspread. She went to a department store and was pleased to find a model she liked on sale. The spreads came in three sizes: double, queen and king. The usual prices for these quilts were $200, $250 and $300 respectively, but during the sale they were all priced at only $150. So, regardless of the size, all were priced at $150. My friend bought the king size quilt and was quite pleased with her purchase, though the quilt did hang a bit over the sides of her double bed. The consumer's choice can be understood by incorporating the value of the deal into the purchase decision calculations. So, here the individual purchased an oversized quilt just because she liked the deal. So, this kind of things are also addressed by mental accounting and given certain terminology. A second component of mental accounting involves the assignment of activities to specific accounts. Both the sources and uses of funds are labeled in real as well as in mental accounting systems. Expenditures are grouped into categories like housing, food, etc., and spending is sometimes constrained by implicit or explicit budgets. So, budgets actually play an important role in mental accounting. Funds to spend are also labeled both as flows, which are like regular income, versus windfalls, and as stocks like cash in hand, home equity, pension wealth, etc. So, in economics, flow and stock concepts are very common. So, in a similar fashion, the funds are also categorized as flow and stock concepts. Maybe we are not doing it deliberately, consciously, but then that is there at the back of our mind. When mental accounting does the analysis, then we would realize that actually some such things goes on in our mind. So, in this context, another anecdote by Taylor. A few years ago, I gave a talk to a group of executives in Switzerland. I refers to Taylor himself. After the conference, my wife and I spent a week visiting the area. At that time, the Swiss franc was at an all-time high relative to the US dollar. So, the usual high prices in Switzerland were astronomical. My wife and I comforted ourselves that I had received a fee for the talk that would easily cover the outrageous prices for hotels and meals. Had I received the same fee a week earlier for a talk in New York, though, the vacation would have been much less enjoyable. So, basically what he tries to say is that since he received an amount because of the talk that he delivered, that was expected to take care of the expenditures, because that was considered as a windfall. The similar windfall, even if would have been there, but at a different place at a different time, then probably they would not relate it with the expenditures that they were incurring in Switzerland, right. So, getting it in Switzerland, spending it in Switzerland, that windfall, that additional amount to be spent on additional expenses were absolutely acceptable. Otherwise, they would have been find it difficult to manage their expenses in Switzerland. The third component of mental accounting concerns the frequency with which accounts are evaluated, a concept labeled as choice bracketing. Accounts can be balanced daily, weekly, yearly and so on, and can be defined narrowly or broadly. So, how these accounts are balanced, evaluated or defined, that is basically dealt with in choice bracketing. Basically how your choices are bracketed. So, narrow framing is an important concept here. We will be talking about choice bracketing later. An analysis of dynamic mental accounting shows why this is an excellent advice in many situations involving decision making under uncertainty. Overall, mental accounting helps us to develop a better understanding of the psychological processes that underlie choices and decisions. Taylor's landmark article Mental Accounting and Consumer Choice, published in 1985, uses the concept of mental accounting to move further toward a behaviorally based theory of consumer choice. He says that mental accounting has a lot of implications and applications in the field of marketing. The mental accounting theory has three key features. First, the utility function is replaced with the value function from prospect theory and then extended to apply to compound outcomes. So, this utility function is replaced with the value function from prospect theory. Mental accounting actually heavily draws from prospect theory. Second, price is introduced directly into the value function using the concept of a reference price. The new concept of transaction utility is developed as a result. We also have a concept of acquisition utility along with transaction utility. Third, the normative principle of fungibility is relaxed. Numerous marketing implications of the theory are derived. The theory is also used to explain some empirical puzzles. Now, normative principle of fungibility implies that the neoclassical suggests this should be the norm that money is fungible. That basically solves, or they say that a rational individual would be treating money as completely fungible. But this assumption is relaxed in mental accounting in the sense that mental accounting understands that money is not fungible. People have spent categories regardless of whether you are today in an era of lot of digitized transactions or when the transactions were not that much digitized. Nevertheless, we have some mental account of what is coming to us, how it is coming to us in terms of funds, finances, and then how we are spending it. So, this is how we basically, or the mental accounting theory of mental accounting relaxes the assumption of fungibility. The primary reason for studying mental accounting is to enhance our understanding of the psychology of choice. In general, understanding mental accounting processes help us understand choice because mental accounting rules are not neutral. That is, accounting decisions such as to which category to assign a purchase, whether to combine an outcome with others in that category, and how often to balance the books can affect the perceived attractiveness of choices. They do so because mental accounting violates the economic notion of fungibility. Money in one mental account is not perfect substitute for money in another account, which is basically the definition of fungibility. Because of violations of fungibility, mental accounting matters. Now, we wish to understand the decision making process of an individual or a household interacting in an economic environment. How does a person make economic decisions such as what to buy, how much to save, and whether to buy or lease an item? And how are the outcomes of these financial transactions evaluated and experienced? So, we have presented certain anecdotes, and I am sure you will be able to associate with your experiences that similar instances have happened in your life as well. We all experience such things. I know a friend of mine, when we were shopping together, she generally wears 37 size footwear. Now, in Woodland there was some there is generally this year-end sale was going on. So, a pair of sandals were available at a substantial or lucrative discount, but it was only size 36 that was available. So, she purchased it though it was fitting her somewhat tight, and since wearing it pretty much uncomfortable, it has been several years, maybe 7-10 years, she has hardly used it. But Woodland shoes are generally pretty sturdy, and as a result of which the pair of sandals are actually still in good condition. She is not able to throw them away, she is not able to use them much either. So, what is the right time to throw those pairs of sandals? We will talk about that also in mental accounting, that when people feel or think that it is time, we can throw a pair of sandals which are lying with us for long period of time, not being unused. It has occupied a space in my shoe rack for substantial time. So, now it is time I can throw it out, right. But this is a decision, the deal is very attractive. So, we go for that kind of purchase. So, these are all part of mental accounting. Mental accounting helps us in answering those kind of situations, that why do we end up buying something even though later on we find it difficult to utilize. Now, how in order to frame the theory, mental accounting uses certain framework. So, again we need to frame gains and losses. It heavily draws from the prospect theory, as I have already mentioned. So, the value function of prospect theory can be thought of as a representation of some central components of the human perceived pleasure machine. It has three important features, each of which captures an essential element of mental accounting. So, we begin with the different features of the value function of the prospect theory that we have already discussed in the previous topic. So, the first one is the value function is defined over gains and losses relative to some reference point. The focus on changes rather than wealth levels as an expected utility theory reflects the piecemeal nature of mental accounting. Transactions are often evaluated one at a time rather than in conjunction with everything else. So, of course, there are situations where we integrate, where we segregate, but then there are always a reference points for processing a particular transaction. Second is that both gain and loss functions display diminishing sensitivity. We have also learnt about it while studying prospect theory. So, the gain function is concave and the loss function is convex. If you happen to remember, then we had an S-shaped function like this. This is in the domain of gain and this is in the domain of losses. This is a concave function, this is a convex function. This feature reflects the basic psychophysical principle, which is also called the Weber-Fechner law, that the difference between $10 and $20 seems bigger than the difference between $1000 and $1010 irrespective of the sign. And finally, the third feature is of loss aversion. Losing $100 hurts more than gaining $100. Gaining $100 yields pleasure. So, as if you remember that the slope of this gain function is much lower than the slope of this loss function. The loss function is steeper. So, this is what is implied here. If I take x here, if I take x here, and we are measuring values here. So, this is x, this is minus x, this is the amount of Vx and this is V minus x, and of course, this is in negative. So, minus V minus x, and what it says is that this is actually much greater than this. So, the influence of loss aversion on mental accounting is enormous, as will become evident very quickly. So, with this I conclude this module on the introduction of mental accounting. In the next we will proceed further with different aspects of mental accounting. Thank you.